Welcome in, folks. It's a four-piece here today. Buy one, get three free. First one up here, Celsius, which stock price is up a shocking 5,700% in the past 5 years. Yeah, that's insane. That's a life-changing stock. We're going to hear what's going on with them. Their CEO went on CNBC in a little 3-minute clip here. Want to watch and see what's going on with that business. We'll talk about Celsius stock if there's an opportunity or not there, okay? Then we're going to get into this one. PCE numbers just came out, so a few hours ago, I want to go ahead and get into that, kind of give my opinions and perspectives and what that means for the market next week, okay? Then we're going to get into this one. We got Cam. Cam's talking about a lot of things in the market and kind of what she's looking at, so we're going to hear what Cam has to say. And then Tony Dwyer, buy stocks on weakness that typically benefit from rate cuts. So looking forward to getting that one. Appreciate y'all joining me. You know the drill. Hit the like button, smash it, lightly tap it, whatever you want to do. It's okay with me, okay? And also make sure you subscribe to the channel if you're not already. 43,000 plus subscribers now on the channel. I appreciate each and every one of you. Let's get into this.
Exclusively to discuss is John Fieldly, the CEO of Celsius Holdings. John, it's great to have you on the show. Welcome. It's pretty incredible. When I look at Celsius's 2023 revenue, it was a record year for you. Revenue sales grew 102% year on year. So you set the bar very high for yourselves. Can you continue to hurdle it? How important is international expansion to that ability to do?
Their growth even outstripped Elf on a Shelf. That's crazy.
Yeah, no, last year was a great year, 1.3 billion in sales. You know, you talk about trends. Celsius is capitalizing on today's health and wellness trends. Fitness, we talk about our drivers. Fitness, the international expansion is a great growth driver for us. We just announced the expansion into Australia, New Zealand earlier. This month, we talked about and announced an expansion opportunity. We're going to expand in the UK and Ireland as well. So the same health and wellness trends we're seeing in the US, we're seeing them globally. And then we also just announced further expanding our partnership with PepsiCo in North America with an incentive program, which further aligns our interests and will allow us to capitalize further on the great opportunities we're seeing in trends today in 2024.
All right, guys, I got to be honest with you. One thing that actually makes me like Celsius a lot, okay? You want to know what it is? It might seem silly at first, but it's not silly, okay? The CEO, okay, this man is all about that branding. Like, he's like, I'm going to go on for this interview. I'm going to make sure we got a TV showing all the Celsius stuff behind us. I'm going to hold a closed Celsius while I record this video, right? When you just got a hustler like that running the company, you're usually going to do pretty good over time, okay? That's what you need in business. You know, a lot of these C-suite type folks that, went to the university and then just rose the corporate ranks, they don't understand about this sort of like dedication, this sort of, just understanding of being a hustler and like doing everything possible to, increase a sale. Like, man, 5 people watch this, it's going to increase our sales X amount. Like, that's a different mentality. And just, very few folks really have that sort of mentality. That's a true entrepreneur type, mentality.
And then also another growth driver we have is resets are coming up, which typically happen when retailers in March, April, May, and we're anticipating the biggest really reset season the company has seen, just due to the great growth and trajectory the company is on. And those health and wellness trends continue to get stronger each day, and Celsius is capitalizing on it with a refreshing, great tasting energy drink and offering. Just really exciting times.
Okay, I want to go back to this amended agreement with Pepsi, because you've had that in place for over a year. The filing came out yesterday. Investors sold your stock. Your stock's down almost 9% over the past week, despite the big gains we've seen since the start of the year and over the last 12 months. Walk me through this amended deal and what perhaps is getting missed by the market here, since you are talking about it as a next growth lever.
Yeah, I think, when we look at it, it's really an incentive program we put together to further align our interest, and also allows us to be a further prioritization within the great PepsiCo portfolio. And then what's interesting, when you look at Celsius, we're really going after not only the energy drink opportunity, which we see, but also total beverage. We just expanded into Jersey Mike's. We see a lot of opportunity on usage occasions outside of traditional energy. And when you look at it, what the big transition when you look at increasing your consumption levels, bringing more consumers in, is it's activating at the point of purchase. So it's really important that we really support these resets coming in, get secondary placements, take advantage of cold availability. And this incentive and program really aligns our interests with Pepsi's interests, and we both win further on success.
So let's talk about the bad with Celsius before we get into the good, and then we'll get into this more market-related stuff here, okay? So the bad is pretty obvious in regards to Celsius, and the bad is the valuation, right? It does not trade at a cheap valuation. If you've ever looked at the P/E ratio of Celsius, a forward P, it's certainly not a cheap stock, never mind the price-to-sales ratio, right? Certainly not a cheap stock. More like a very expensive stock. But with that being said, I've kind of thought about Celsius a little bit, and I got to say there are some things I really like, right? Obviously, if you don't know, back in the day I used to own Monster Energy, which was called Hansen's Natural Beverage back then, right? And I certainly didn't make 5,000+% on the stock, but it was a good stock. But the beautiful thing with Monster is it was an expanding brand. They kept expanding SKUs in stores. They kept expanding to more stores, more countries over time, right? And obviously the product, it's got caffeine in it, so therefore it's pretty addictive, right? And so those sorts of products usually do very well. They usually get repeat purchases. So Celsius has that. And so that's really good, right? But the other thing I really like is international seems like it's a very early opportunity for them. So if they can be successful international-wise, that's huge for this company over time. So I'm looking at Celsius and I see a company that's definitely headed in the right direction. And the one last thing that I like with Celsius is Red Bull gives you wings. Okay, no. Red Bull, the thing with Red Bull is management there, we've talking about a lot of changes in Red Bull over the past, 25, 30 years, right? Red Bull really came to become popular about 25 years ago, 25 years ago, right? And so there's been a lot of changes in that C-suite over time. It's not the original folks really running that show who were the originators that made Red Bull to what it is, right? And then when it comes to Monster, I can tell you the two gentlemen that have been running that company since, basically when they bought it out and they started the Monster brand in 2002, both those gentlemen are up there in age now. So I don't know how much more time they have as far as caring to run the company, and they're both insanely rich now at this point in time. So my guess is they might be getting out of the business rather soon. And so that leaves then kind of like the corporate folks to take over, right? And then you have to compete with a Celsius that has this like hustler, leading that company and is just going to think differently and whatnot. And so yeah, I gotta say, I actually I like Celsius. Now, am I gonna buy the stock? I don't know. We'll see about that. Okay, but if it comes down to the right valuation, I'll buy just about anything. Okay. Next one up here, key Fed inflation gauge rose 2.8% annually.
The big moment we've all been waiting for, our February read on personal income and spending and all those inflation numbers. On the headline, as Steve pointed out, expecting up 0.4%, comes in at up 0.3%. Now, the revisions aren't showing yet, but maybe as we go through the rest of the numbers, they will. Personal spending up 0.8. That is a stellar number. 0.8 is the best number going all the way back to January of 23. If we look at real spending, up 0.4%, that is the best level going back to December of last year. And if we look at the deflator month over month, up 0.3 as expected. And here we go. Year over year deflator, 2.5, 1/10 higher than 2.4, which was the lowest level since February 21. This is 1/10 higher than that, but as expected, it really does break a streak of numbers moving lower. Now, let's look at the PCE core deflator month over month, and that is up 0.3. Definitely less than 0.4 in the rearview mirror, as expected, and my favorite is 2.8 on the PCE core deflator year over year. 2.8 as expected, which means it remains at the best levels since March of 21. Okay, revisions are coming in now. I'll hit the ones that are most important. On the year-over-year core, I just went over. Last month's 2.8 now becomes 2.9. So we're actually lower. But if I was the market right now, Steve Leisman, my guess is that these numbers are generally as expected, but we're not making progress on year over year. So the market.
And this is an issue, right? This is a big issue, and that's what cracked me up. Of course, it got revised upward, right? And this is a trend we're seeing. This is why people don't trust a lot of this government data, because it comes out and then like more than not, it seems like everything gets revised worse than expected a month later. And they're like, we're revising this. And it's like that with unemployment many times and in jobs and in all these sorts of metrics. And so this is why people have huge trust issues with government numbers. And it makes sense.
You're going to have to fight that out.
Steve,
Rick,
want to get your reaction to this as I hear you say,
Let's
wow.
add to that.
Rick, you are the market, Rick. I don't know if you were the market. You are the market, man.
Today he's the only market.
Look, it's chill on the inflation numbers. It's hot on the consumption and the spending side. As far from what I can tell, income was 0.3, but outlays was 0.8. I mean, that's blowing me away. What did you say, Rick, about real spending was up 0.4%? That's inflation adjusted?
Yes,
Is that 0.4%.
Yes, 0.4%.
Diane,
exactly
Diane.
Right.
All right, Diane, right here on TV, putting the pressure on you. This is going to upgrade our first quarter GDP numbers, isn't it? What do you got? Can you do it on TV?
And in fact, I'm looking at the.
Do it in your head.
I'm doing in my head close to 2.5%. I'm thinking on the first quarter. So how's that for you? But I do think what's also important to remember, Waller pointed this out as well, and it's where everyone had declared victory. And Rick, you're right on the year over years, but the 3-month moving average, the 6-month moving average on all of these figures has moved up with these numbers, as far as I can tell, with the revisions as well. They've moved up. That is the wrong direction on momentum for the Federal Reserve on CPI, and with that strong consumption number out there as well. That's going to be, we already have people staking out the sort of pushback for a June cut. What's the rush? Wait a little longer. 9 of the 19 participants wanted 2 or less cuts, and it's only 1/4 point move by one person within that meeting that brings it down to 2 cuts for the year. I know that's splitting hairs, Steve, but the timing of rate cuts keeps getting moved out. We need to see a lot of improvement in terms of inflation in March before we get to a June cut, but also a big slowdown in employment.
I'm shaking my head, Diane. Diane, I'm shaking my head because I don't think this market needs to see anything from the Fed. The way they've been trading, it's been quite remarkable, right? I mean,
the market may not. I'm talking about the Fed.
The
Yes.
Fed, I'm saying right. A very significant, I'll let Rick and Northern talk about this, but I just point out you've had a really significant reset on Fed expectations, down 300 basis points for the year-end funds rate over the course, and stocks have gone up and hit new highs in that context. And I think that's the context for everything we're talking about here today.
So what does that mean for the stock market this upcoming week? I think it means a whole lot of nothing, just to be honest. The fact that a lot of those numbers just came in kind of what was expected. I don't think that's necessarily great bullish news, like everybody's going to flip out. I don't think that's, super bearish or something like that. I think it's what was expected. So I'm not expecting a huge move either way. The revision upward to 2.9 for last month, I think is more cause for concern, because then you look at this number and you're like, well, is this number real? Or is this going to be something that next month we find out's higher than expected, right? And the Fed looks at all those revisions as well, and then they make judgments based upon that. So, I don't know, maybe cut in July, but we'll see. We'll see. It just seems like things keep getting pushed out. If commodities keep running like they've been running this year, we're in trouble as far as inflation goes, right? We were watching tech really closely in the second quarter. Cam, let's hear what Cam has to say.
Sir, with me once again at Post 9. It's nice to see you again.
Nice to see you.
All right, so the curtain, as I said earlier, is coming down. We're going to turn the page to a new quarter. Do we still have momentum to keep this going?
The market certainly does have momentum, but the catch is some of the momentum stocks have started to stall out a little bit. And that's what you mentioned in talking about tech. Tech has certainly started to lose a little bit of its momentum. Now, it's not outright weakening, which means that the market is still able to go up because you're getting the benefit from things like energy, financials, industrials, materials, all doing better. So we're watching tech really closely into the second quarter, because if that goes to weakening, that would be something that could be an issue for the markets.
It could be an issue, even as you suggest, and rightly so, the broadening that we've seen lately. As tech has weakened, other sectors have picked up the slack. Over the last month alone, 1, 2, 3, 4, technology is the 7th best performer.
Yeah.
Energy's the best. Materials, utilities, comm services, industrials, financials. Isn't that what we want?
It is what we want, and the important thing here is that tech is still in an uptrend on an absolute basis. The weakness in tech has been more relative. It just means it's not doing as well as the other parts of the market. And so if tech actually flips into outright weakness, it's such a large part of the index. That's where the index could have challenges. But the breadth is really powerful. 85% of names are trading above their 200-day. That's not something that you typically see at market tops. Breadth weakens going into a top. You don't have a top and a top in breadth at the same time.
How should we feel about earnings, which are going to get hot and heavy real quick? Expectations have come down. I mean, the numbers have for the first quarter, they're about half in terms of earnings growth.
Earnings season basically starts in about 2 to 3 weeks from now, everybody.
They were at
when
this rally started in October.
Yeah, I think your point on halftime was really interesting, is that you've seen this all be about multiple expansion as you've been cutting earnings. And earnings estimates have gone up slightly for the full year, mostly for 2025. But this has been all multiple expansion. Even in those cyclical parts of the economy or the parts of the market, multiples have gone up by 30% plus for industrials and materials. So you really do have to see earnings deliver in order to make sense of a lot of these multiples.
You think we will? I mean, there's a thought that we will. You know, Wolf had a positive note out today, says outperformance is going to continue.
I think that you're set up for better cyclical activity, most certainly. So PMIs, we think, are bottoming. Early indicators in PMIs are telling you that you're seeing a cyclical recovery, which suggests that earnings can do better, mostly now that you've lowered the bar for earnings. But if we're continuously seeing that trims in the out years on earnings, I think that's something we'll have to watch closely.
Are you skeptical that the sectors that have led over the last couple, 3 weeks can continue to do it? Are these like one-off anomalies, or is this the start of what you think could be a new and positive and more broadening trend?
I think we have 3 to 6 months on this cyclical trade. So cyclicals typically do well as you're starting to see activity bottom. The risk you have is once activity bottoms, earnings estimates go up, then you're trading at a peak valuation on peak earnings, and that's when you have a challenge. So there is still air left for this cyclical run to happen. I think you'll have to watch once PMIs get into the 53.
So I do think it's important what she said there is this is 100% accurate. What's in front of your face right here, okay? The mantra here is, quote, we're here for a good time, not a long time. That's right, Cam, okay? Also, you can ride the cyclicals for now, but the story can change quickly. Yes, cyclicals, that's the problem with cyclical stocks. That's why I don't really like cyclical stocks very much at all, because they're more of swing trading type stocks. They go through these insane ups and these insane downs, and they always trade at very low PEs. Home builders are a good example of that. Home builders have been red hot for the past year, right? But that will come to an end. Predicting when it's going to come to an end, that's a hard thing. Is it 3 months, 6 months, 12 months from now? It will come to an end, and those stocks will crash, and it will be pretty ugly there for a bit, right? Autos go through that sort of thing, right? Tesla, I like to own, not just because it's an auto play, but it's a play on so many other things, right? It's obviously tech plus auto. And so cyclicals, not great. Material type companies, not great for long-term holds. You know, companies like Caterpillar, Deere, great companies, not the best. Boeing, same exact thing. So those sorts of companies, man, they're up, they're down, and it just seems like, you know, the last moment you want to buy those stocks is when everything looks great for them. If you are ever going to play cyclicals, it's usually you want to get into them when everything looks horrible, when their numbers are horrible, when their stock's in a horrible place, all those sorts of things.
54 territory, that's when you might want to take some chips off the table.
How reliant are we in this quarter about the Fed?
I don't think we've been that reliant because we've gone from 6.5 cuts to now 3. And if 3 becomes 2, will the market really see an issue with that? We think the key reason why the market continues to do well is because GDP forecasts continue to go up. They've gone from 1.2% for 2024 to start this year to 2.2%. Risk assets love that. So the key thing to watch may not be the Fed. It may be GDP forecasts and the expectations about the economy, which would drive the market up or down.
Alrighty, next one up here, buy stocks on weakness that typically benefit from rate cuts.
Hey here, Mel. It's great to see you guys.
So here's the first question, though. Rate cuts happen in a backdrop of the economy weakening, or is it because, I mean, what happens
So it is weakening in the employment data. And I think one of the most aggressive topics that I talk to clients about is how bad the incoming data is. So I'm going to take you a little bit in the weeds here. There's something called the initiation survey rate. It's when I reach out to you and say, how many people do you fire? How many people do you hire? I'm the BLS, you're the company. Before the pandemic, 70% of the companies would get back to the Bureau of Labor Statistics and say, we laid off this many people or we hired this many people. Last in January, it was 27%. So we're getting employment data. We got 167,000 job negative revision in the last payroll employment report. And it's not that they're manipulating.
And once again, this goes back to why people don't trust the government data.
The data, the conspiracy theorists go bananas with this stuff. It's really that they don't have a good collection mechanism. So the revisions are significant, and most of them have been negative, Mel. Mm-hmm. So I think that some of the Lululemon, some of the consumer hits that have happened, if you looked at Lululemon a month ago, it's up and to the right. Yeah. It's parabolic. It's like everything else. And if you look at the Russell 2000 a week ago last Wednesday, it's down for the year.
Wait, what did he say? Up and to the right? Lululemon. Wait. What? Lululemon stock is in a horrible place. What is he saying?
Last payroll employment report. And it's not that they're manipulating the data. The conspiracy theorists go bananas with this stuff. It's really that they don't have a good collection mechanism. So the revisions are significant, and most of them have been negative, Mel. Mm-hmm. So I think that some of the Lululemon, some of the consumer hits that have happened, if you looked at Lululemon a month ago, it's up and to the right.
If you looked at it a month ago, okay, yeah, that's fair. Not anymore.
It's parabolic. It's like everything else. And if you look at the Russell 2000 a week ago last Wednesday, it's down for the year. So I think it's just a little bit of perspective on the economy slowing and what it might mean for rates and the consumer.
So what benefits in that environment where the economy is weakening?
Yeah, the issue is, with some of this, you get some good data, you get some bad data. Oh, they're talking about, previous video, they were talking about, GDP might be above expectations, right? He's talking about weakening data. He's talking about government numbers are then getting revised worse, right? So where's the Fed play in all this? Well, the problem with the Federal Reserve is they don't take actions really until it's like too late. And it's so far in front of their face that it's indisputable at that point in time. They don't really forecast anything accurately, and they don't really make moves for the future. They wait till it hits them in the face. Everybody and their grandma knew inflation was out of control by the time the Fed actually started raising rates. There was no secret. Ask any regular person out there, they'd say inflation's out of control. And the Fed didn't start raising rates until everybody knew it was out of control, right? And so, in trying to predict unemployment and those sorts of things, I mean, the Fed might start making moves when everybody's like, ooh, it's already getting bad. And whenever that is, right? And so, I don't know, that's just a little food for thought in regards to that. The Fed doesn't make moves until everybody already knows it.
And we do have rate cuts.
Well, our focus now is those rate cuts are what you need. You need to kill the zombie, right? And the zombie is an economy that you're waiting for it because of the inversion of the yield curve and the higher interest rates to slow down enough to go into recession. Until something happens with the Fed and lower rates, it's going to be very hard to disprove that you can eventually go into a recession because you normally have. Our view is that all of the earnings growth from 2023 was the Mag 7. According to our earnings wizard, LSEG, it literally was a negative number for earnings growth last year, ex the Mag 7. It's same for this quarter. It'd be a negative number. As we go into the end of the year and into next year, it's much more even. So that's where we're calling for the broadening of the market. It's coming from a broadening of the earnings growth participation. It's not just the Mag 7. So if you get lower inflation and lower interest rates and start to get scared about the unemployment rate going up, that sets the stage for that real early cycle recovery we can get in those areas that benefit.
So I don't agree with this whole notion about buy stocks that will benefit from lower rates on weakness. And the reason I don't necessarily buy that is whenever the Fed does start lowering rates, it's usually because you're going into recession. They're usually not just going to lower rates to lower rates. It's usually because recession's either there or it's coming very soon. And so some of those stocks can still get hit very heavily if you go into a recession.
That sets the stage for that real early cycle recovery we can get in those areas that benefit from lower rates.
So what if you get a little lower employment, but really not a lot of relief on the cuts? Let's say you get one. Does that change your outlook?
It would. Where I'll be wrong is if rates stay here or actually go up. I find it very hard to believe that that's going to happen, Kara. Like, if you think about when rates were going up, it was the end of the higher inflation where they did 4 rate hikes of 75 basis points at a clip to slow it down. The trajectory of the core PCE, which we get tomorrow, is exactly the opposite right now. So if it goes down a little bit more and it stays on this trajectory, you get a continued move up in the unemployment rate. You get a continued move down in the inflation rate. Karen, I can't imagine they're going to go 25 basis points after going from 0 to 550. They're going to go, oh, 25 is enough. We're good.
Zero. So zero, that's
yeah. So call it 2 to 5. We're that 5 1/4 is the upper end. Maybe it comes to 4. That's enough to really kickstart. That happens with weaker employment. That happens with weaker spending. And I'm not saying they have to go back to 0, but they have to be more aggressive to reinvert in whatever they do to get the curve back to normal.
So we've gone from higher for longer, right? That was the mantra. And of course, the exact opposite happened. Rates dropped from 5 to 3.8. Then at 3.8, consensus was there'll be 6 cuts, 7 cuts. That's all off the table. Now it's 1, maybe none. What if there is, just as you're implying, nothing? They just stay pat.
Good question. Good question.
By the way, it was a political term back in 1896, referring to patents, but it's still a poker term. We should keep moving.
Remember, they were only going to do 3 hikes.
Right, 3 hikes. So 3 hikes
and then 3 cuts.
But let's say they actually just somehow keep juggling the ball and do nothing. Do you think that is Goldilocks or that's a problem?
I think that creates a bigger recession. Problem. Yep. I think the Fed needs to get, I'm kind of on Steve's camp, the Fed needs to get aggressive here. Remember, when inflation was moving up and spiking like it's moving down now, they were telling us they were only going to do 3 hikes. We're good after 3 hikes. That's the peak rate. Not so much. So if you get weaker employment, the whole picture here for the economy is we're at full employment. Manufacturing's been in a recession for the better part of 2 years. Non-res construction's turning over. So
really quick, because I know we don't have a lot of time left, but I heard you say zombie refer to our economy.
That was a great question. I'm glad he got that in, didn't get distracted there, because that is like a good question. Like, what happens if the Fed doesn't lower rates this year, right? And I believe I'm 100% on the board with him in terms of the thought process of, okay, they don't lower this year, probably creates a bigger recession down the road, right? Whenever that ends up happening, right? They'll just create more problems out there in general, right? So I'm definitely of the belief, on
zombie terms. And yet we also have a dynamic also out there for markets where financial conditions are out of control.
So without Fed moving.
None of this seems to make sense, and yet you think the Fed hasn't moved fast enough, and I think they lit the market on fire last week.
Oh, they absolutely lit the market on fire by staying with 3. Remember, they revised the growth and inflation up, but stayed with 3 cuts. He also said we're at the peak of the cycle in terms of rates. That was not gray. So I'm not saying that we go into a service-based recession and the market collapses. There is no history I can find with this kind of momentum that calls for market collapse. At this point, when you're this overbought and this extreme to the upside, you just want to wait for a better opportunity. In our view, that comes with this worsening employment data that cuts rates. You worry about the economy. That's when I want to go in, not levered long at, after the kind of rates that we've been, or the kind of moving stocks we've been talking about.
Yeah, a little worried about, once again, commodities, right? And I'll show you guys kind of what we're looking at here. And this is what is giving me a little, concern out there. If we look at GSG, the commodity basket, there it is. So far this year, up over 10% now at this point in time. Holy smokes, is that accurate? Double digits? Holy smokes. So that's the issue right there. You know, if this continues to roll into summer and you get oil price, next thing you know, I mean, we're at 83 already on oil price. Let's say this summer we hit 100 plus, then you got inflation problems. You still got inflation problems in the economy. And what does the Fed do if commodities are going through a major bull run? With oil going through a major bull run, like, what does the Fed do? Like it's going to be hard to cut. It's going to be extremely hard to cut if that's the scenario that plays out, which then makes them potentially even have to consider raising rates again to calm the commodities market down and make more recession fear. So that's a whole dramatic situation. Okay, so we'll see how it all shakes out, but yeah, it's going to be quite a show. Okay, appreciate you guys joining me as always. Thanks so much for being here. If you're looking to learn on the deepest level from me, everything I got up here, then apply to join a private group. We can see if we can get you in there next week. That will be the pinned comment down there. You can click on that and go ahead and fill out an application. And once again, we'll see if we can get you in there next week. Access to all my premium course curriculums, our Discord chat, be able to see the moves I make my $2 million plus Fidelity account, all those sorts of things. Much love and have a great day.